According to market participants, rupee is likely to remain under pressure as a fallout of the US Federal Reserve indicates more interest rate hikes. US Federal Reserve Chair Jerome Powell last week indicated more rate hikes in the US Central Bank's efforts to combat the highest inflation in 4 decades. The rapid rate hikes will weaken demand and increase the likelihood of a US recession. As a result, there may be a greater risk of imported inflation in India, a weaker rupee, and a faster rate of capital outflows. This month, market participants are closely going to keep an eye on the Fed's next Federal Open Market Committee meeting, which is scheduled for September 20 and 21. The Fed rate hikes reduce the spread between the US and Indian interest rates, making India less attractive for dollar investment. Let us see what economists have to say about hawkish Fed mean for the Indian economy, growth and RBI policy.
Last week at the Jackson Hole Symposium, we saw, hawkish comments by Fed members, and Jeremy Powell, who's the Fed chairman, reiterated the fact that inflation still remains a concern in the US. We are looking at a lot of the economic activity indicators that are coming out of the US economy, and they continue to remain very, very strong. I think given this scenario, the expectation now is that the Fed will continue to be aggressive in terms of its rate hikes and probably deliver a 75 bips rate increase in the September policy. What this has led to is, a lot of volatility in equity and currency markets. The dollar index has, continued to remain very, very strong, which has meant pressure on emerging market currencies like the rupee. Surprisingly, I think that the rupee has been an outperformer within the emerging market space over the last week. There are a couple of factors that have supported the rupee more recently after it, touched above 80 levels on Monday. One is that, with the recession risks rising globally, as well as, a slowdown in China, oil prices have come off yet again. They are now closer to, $95 per barrel levels. This is a positive for our own current account as well as for the rupee. Moreover, we have seen very, very aggressive RBI intervention, and they have been in the market supporting the rupee and using their large FX reserves, to curtail volatility in the currency pair.